Good afternoon, Scott Redler T3 Live. Welcome to today's recap. Wow, what a day. Fed day here and gone. Every single economist, I don't care who you think it is, how great they think they are, believe it or not, nobody. Well, I guess, they said two people got it right, said that, they would do zero. I personally thought the best thing for them to do would be between 10 and 12. That was just my thought because I'm a strategist, technical analyst, trader. I'm not an economist. I just figured that's kind of what the market wanted to hear, to have us in, the same consistent uptrend with, with the movement like we've seen for most of 2013, which is buy dips and look for quality stocks and breakouts and stick to trends. So when we came into the Fed meeting, we were all talking. That's what we do on the VTF. We talk about if this happens, what should we do? If that happens, how do we handle it? So I was like, okay, here's the deal, guys. If they do announce 10, 12 billion, it's probably just like a normal Fed day where up a little, down a little, few fake moves, and then, we'll see how we handle, 170, 130. If they announced 15 to 20 billion, probably get hit real quickly. Let's think about, levels of support, 169.5, 168 spots we could buy. And if they actually do 5 billion, I'm like, which I don't think they would. Why would they just, do 5 billion? That's like a token saying, okay, we don't think things are ready. Then you buy the TLTs, you short the TBTs, you buy gold, and probably everything goes together because it's just full-fledged, rates are going to be low and whatever. So anyway, when they announced zero, we all looked on the floor like, all right, zero. I'm like, that's kind of crazy. How'd they do zero? And everything kind of happened that you thought about, but it was a little odd. So some traders like myself, I got caught a little flat-footed where I wasn't all risk on, which I'm not into any events usually, whether it's earnings, whether it's situations like this. Don't need to be. There's way too much money to be made by just following trends, having positions when things aren't, as inflection point focused. But we had the level 170, 125 was that level if you wanted to grab the spiders quick. And, if you've been rolling up your shorts since the late August lows, that was your last decision spot. You had a few other decision spots, but that was your last one. So anyway, with zero, the market started to rally. Gold did what it was supposed to do, went up. TLTs did what it was supposed to do. They went up. TBTs went down. And then also, if you think about it, put 1 plus 1 together, what's been getting a little beat up and lagging because of rates higher? That was housing. So some people said right away, oh, I'm buying housing. XHB outperformed. Oh, what about the utilities? They were hot in the beginning of the year and corrected once people started going for growth, and they resumed. So you had to have all these things in your head, to act quick, or say, what, let me let the dust settle a little bit and figure it out. But overall, if you're a macro investor, which we talk about, and you've been putting monthly money into the stock market, you survived 1987, you survived 1998, you survived 9/11, 2001, 2007, 2008. Last year, the European Union was supposed to dissolve. Mayans said the world would end, and now you survived all the ghosts of September. So go back to work and stop reading the headlines and worrying about, the fear-mongers trying to get you off your plan. But anyway, let's just start going through a lot of things here. SPX, real quickly. Here's a chart. Charts don't lie. This has been the trend since November, following it all the way up. Here is where you had the last Fed day. What did this do? It did an outside day, traded above the prior high, closed on the low. That was a bearish distribution signal. What did it lead to? A 5% decline. Okay, from there, held the 100-day, bounced, digested, went higher. Here was your small little head and shoulders top. Gave us a nice tradable correction over the summer. And then right here is when everyone started saying, oh, we could see 1987. Oh, 2008. Oh, we're going to have a 15% decline when we didn't even get really below the 100-day. And we regrouped. And right here, I think this was the most clear-cut spot to make adjustments. You could have been like, okay, I'm short here. My stop is going to be if we reclaim the 50-day, or break above this ascendant trend line around 1664. And then from there, you wanted to see if things were real, right? What kind of commitment do you have to this rally? So here was a gap up. Did it fill the gap? Did it fall apart? No, it digested. Then you had another gap up, okay? What did it do? No, I know there was no follow-through on Monday, so everyone was calling for the end of the world because, or this was Tuesday, whatever. No, I think this was actually Monday, whatever it was, right in front of old highs. Of course, you're going to have some resistance. And then yesterday, you had an inside to positive day. And then today, we busted above this zone. We talked about 1709. That was the zone. That was your last spot. If you're short the whole way up, if you've been short this whole trend, cover there, guys. You could always save yourself some money. And, if you've been riding things and letting them work out, great. Now, with that said, taking a look at some of the, the different sectors, XLF, near the highs, some stocks in there. I think Goldman was actually very tricky today. I got stopped out early and then came back to it. Let's hope that this breaks above highs soon. Bank of America, tried to get going. And, it's a little bit. I would say if you still have them in the drawer, it's fine. It's just slow if you're trying to trade it. Don't just let this be one of your few positions, but trying to poke its head maybe after Friday when they're out of the Dow, it could break above 15. Morgan's actually been one of the stronger ones, at the highs. Citigroup today showed some relative strength, tried to break out, so the banks are on their way. I told you about the home builders. Look at this potent move in the home builders. First of all, home builders, really, if you look at the long-term trends here, it stayed intact, okay? People were pointing to the potential of a head and shoulders top pattern, but it never broke and closed below the neckline of 28. So then when it bounced off it, you switched some gears. Bounced off it, look at this potent wide range bar right there. That's what we call an igniting bar, into a trend line. And then what did it do here? It digested, showing commitment to that, and then there you go. A lot of guys in the chat room jumped on some of the individual names, whether they were Toll or Ryland or you name it. They probably had outsized moves compared to this being just the ETF. XLU, also big wide range bar. This was in a really strong trend to start the year. Remember this corrective activity, and then it bounced, and now, pretty wide range bars. People think, they're not going to be getting much money in the bank anymore. We got to go with some of these stocks that also have a yield besides, just growth. So anyway, with that said, this was an igniting day, a day one. Now it's got to see if it shows commitment to see continuation there. Other things that we've been talking about in just a tech land, Apple was a bit frustrating. We've talked this pattern so many times. Here's when it broke 503.50. So far you have a little trade here. It was better intraday yesterday when it was down to positive today. It filled the gap pre-market, and that's your 2-day trade, and now it's a wall of resistance. So at this point it's not really, I guess let it build above this. Show some commitment here. That's your real line in the sand. And then at some point, if it were to go sideways and trade through this, maybe we get more upside. But overall, this nice pent-up trade that we had from the earnings gap up and breaking this downtrend changed right there. These are old lines, actually. Google, we talked about that descending trend line that changed right here when it broke above. Okay, then it digested a bit, and wide range bar today. Some guys bought it today and closing the highs, and if you think about it, really, it's been in a channel now for like 5 months. So it's still digesting what has been a really nice move, since it was our 2012 high beta name of the year. So overall, this is a nice action here, working on the right side of its base, and now that's where the highs are. Amazon also, ever since that descending trend, channel right there. Remember, it broke out on earnings and couldn't get anywhere, dribbled all the way back into support. And then right here was that day one we talked about, or what was it, 285-ish? Big move, digestion. Yesterday, guys, we're talking about 302. I think that's where we had it on the price point sheet for action. Here's day one. There's your day two. Look where it is. If you're a stock picker and you've been in Amazon for multiple years, congratulations, you've made yourself a heck of a lot of money. And look at this. You actually look at the monthly here. It's been above the 8 and 21 day for years. So with that said, that shows a strong, also long-term chart besides the daily that you can navigate, on lots of different time frames. Tesla right now is resting a little bit. At this point, it's still above the 21-day. It's a bit lethargic in here, but other stocks were playing some catch-up, so it's kind of been, out of play. I think overall it's still holding where it has to. For this to really get going, it's got to start getting above 170-ish again on a heavy volume. Maybe tomorrow, if we have a digestion day, Tesla likes to stand out on its own, so we'll see. Facebook also. This has been a very dynamic move, okay, since earnings. Little scare the other day, right, when it broke the 8-day, but reclaimed it. Today held higher. We'll see what happens tomorrow. Maybe we get a nice trade into 52-week highs, and that could continue this move from that cup and handle pattern. And then, it's interesting, or not interesting, we played that bounce in gold, okay? Remember we played the bounce? It was like June 28th, the blood in the street lows, GLDs went up to 135, stalled there. I'm like, that's a good spot to sell some of your gold, right? It went to from 1280 to 1420. And then it came in down to 1,300, so good call, whatever. And then at 1,300, what was it, this week? Goldman comes out and says gold's going to be below 1,000, like right before this. It just, you know what? They probably bagged a lot of people. You know, here is a blood in the street lows. Here's a trend. Okay, that's when we were like, okay, you could probably take some profits there. And then right around here, they said it's going to be going back to 1,000. And talked about this morning, if that was the case, it would have to break below 123.50, which it didn't. And then obviously on the zero taper, you know, here was this small little, you know, channel, so to speak, and it gave you a few different opportunities. I think Sperling took care of it really well by, you know, the first initial move. There was a pullback. He bought it, and look how it closed. Okay, so they didn't say it's going to 1,000 here. Okay, they said it's going to 1,000 here. So it just, you know, it irks me a little bit, but whatever. All in all, I still don't know. The jury's out on whether or not this trend that's been intact since, you know, 2013 has fully changed. Okay, it's been relatively macro-wise to the downside. You know, here's, you know, the 160 adjustment, the 150, boom, and, you know, I guess, you know, if you want to broaden this out now and make like this is a new trend, okay, I still don't, I'm not in that camp, but, you know, now if the longer we hold the top third of this, you know, the better the chance the gold guys have a, you know, more upside. We'll see. TBT, we talked this morning how, you know, if for some reason, you know, it's priced in and it goes lower, okay, that long-term rates should be higher. So look at this pattern on an active basis. Okay, it was wedging, didn't break to the upside, came in a little bit, still hanging around there, still by the 50-day. You know, I still think overall on an intermediate basis it looks fine. If, you know, for some reason it sees downside follow through, I do think that if you want to accumulate this, okay, into this area, which we talked about, we said if it breaks up here, you have a high level stop, and then, you know, we'll see how it acts right around here. But overall, this is your intermediate trend line. If you trade those, you know, you could get out of it and always get back in. And if you're looking for a hedge against your bonds, yes, bonds might rally for a few days or a few weeks, who knows, you know, but overall, I do think that, you know, at some point in 2014, if you put things in the drawer, you know, rates will be higher than their peak this year. And that's, I guess that's an opinion. Because, and same opinion that everyone had today about the tapering. You know, we get 1 and 2 numbers, all of a sudden they start tapering next month or the month after. I can't believe we're going to have to deal with this still every single. It would have been so much better if they just friggin' came out and said 10 billion and went the course. Okay, that's what, you know, and it just would have been such an easier path. So now Bernanke basically kicked the can to whoever's going to be next, which probably will be Yellen, and she'll have to start it based on her own decision basis. It would have been better if we got the ball rolling. Okay, I do think the economy is in a better spot. I do think the world markets have been rallying really well. They should have done something, but who am I? I can't control the Fed. I can't control Washington, which is now going through a whole nother, you know, mud field, you know. But what I can control is this, my keyboard. Okay, that's all you can control also is your keyboard and your approach. You do what makes yourself feel comfortable. You do what's in your risk tolerance. You follow a plan. If you could do it on multiple time frames, you could have a nice business. You could have a cash flow active business. You could have a stock picking, you know, intermediate trend following, you know, career. And then you could also have some kind of long-term macro plan, you know, that you combine with your wife or your spouse or whoever it is monthly. And you learn how to do all three. And believe me, you're not going to be saying equities are dead like people were declaring last summer. You'll say equities change, equities evolve. They'll be here with us or without us. Learn how to approach it and do what's best for you. Scott Redler, T3 Live, the recap. See you tomorrow morning. Have a good night.